Alright, in this section, we're going to dive into high resistance liquidity runs, HRLR, and low resistance liquidity runs, LRLR. This entire concept actually stems from the swing points we discussed in the previous video, which you can check out via the link right up here. In a high resistance liquidity run, you have a specific swing high where the price sweeps the liquidity, essentially a stop hunt, and then aggressively drops without forming a failure swing. What happened here is that the price already grabbed all the necessary liquidity resting above that swing high, and then immediately tanked without leaving any failure swings behind. Now, what does a high resistance liquidity run actually mean for us? It means when the price moves like this and has already taken out the liquidity it needed, we do not expect the price to come back and break that high on a retracement. Why? Because it already purged the liquidity required for the move, and our overall bias was already bearish. Alright, so from this point, the price drops down to this area. Here, we get a pullback into this order block. Now, take a look at this price leg. What we have here is a low resistance liquidity run. But what exactly does low resistance mean? It means because the price formed a failure swing instead of sweeping the previous liquidity, that liquidity is still sitting right there, completely untouched. On top of that, even more liquidity has built up around it. This creates a low resistance environment, meaning there's very little friction holding the price back from rushing toward that liquidity. Price can easily target that pool, which is why we typically use low resistance liquidity runs as our take profit targets. The price can easily smash through and hit our target. Now, as I mentioned, this is a low resistance liquidity run. The price retraces up, taps into the order block, and reacts to it. Then, on the way back down, it runs into and reacts to our rejection block. Alright, let's move on to the next example. Look at what we have in this area. Here, we had a high resistance liquidity run where the price made a sharp move up to this zone. After that, look at what these two swings created together, a low resistance liquidity run. Why? Because we had a failure swing. The price couldn't sweep the stops above these highs. Then, the price comes down to take out this sell-side liquidity. Why does this happen? Because we had an HRLR here. Remember, with high resistance liquidity runs, we don't expect this low to get taken out right away. Instead, we expect the internal liquidity to be swept first. So, the price mitigates this high resistance zone, reacts off the order block, and pushes upward. Now, this move itself is also an HRLR for us. But here's the catch. Look at this low and this low. What did they just create together? A low resistance liquidity run. Because of that, this can now be used as a target. That's exactly why the price comes back down later and sweeps this low. So on the initial reaction to an HRLR, we generally don't expect the sell-side liquidity to get purged immediately, unless it pulls back and forms a new swing. When that new swing combines with the previous one to create an LRLR, that is when we expect the stops in that area to get hit. Now, look at this section again. What do we have here? Another HRLR. The price came down, swept the stops underneath, and reacted. On the retest, we again don't expect this low to be broken, especially since our overall bias is bullish. So, what did we agree happens during an HRLR? The price is supposed to go for the internal liquidity. Therefore, we expect it to sweep a specific sell-side liquidity level and then catch a bid to the upside. Once it moves up, where is our target? The low resistance liquidity. And looking ahead, this low and this low have now formed another LRLR, which will serve as our target in the future. And here is another simple example of a high resistance liquidity run. As you can see, the price came down, swept the stops, and then made a sharp, aggressive move to the upside. On the pullback, it offered a perfect 2022 model setup, allowing us to catch the continuation of the move upward. Now, let's look at another example. Look at what we have in this area, a failure swing. The price pushed up but couldn't break the high or sweep the liquidity. Because of that, these highs together created a low resistance liquidity run. After that, the price dropped significantly and hunted the liquidity below this low. This formation gives us a high resistance liquidity run. Then, the price pulls back. If you drop down to a lower time frame, the internal liquidity levels become very clear. The price comes back to sweep the internal liquidity and mitigates this FVG. Remember, internal liquidity doesn't always have to be a swing high or a low. An FVG is also considered part of our internal liquidity. So, it taps into this internal liquidity, which is the FVG, and starts its move toward the target. And where is our target? The low resistance liquidity. Looking ahead, because this low and that low formed a failure swing, they have created a new low resistance liquidity run. If we get a valid setup in the future, we can easily look to target this specific area. Now, let's look at an example on gold on the 15-minute time frame. In this area, we had a high resistance liquidity run. The price pushed up, swept the buy-side liquidity here, which is also an HRLR, and then moved downward toward this prior high resistance zone. When it reacts here, we don't expect the price to instantly break below this low. Instead, we expect a reaction off its order block. As you can see, the price bounces, takes out this low resistance liquidity run, LRLR, and reaches the area that was originally our high resistance zone. Once again, we don't expect the price to just blast through this high right away. So what happens? It reacts off the bearish order block and forms a failure swing. And what do failure swings create? An LRLR. Price then targets that low resistance liquidity, wiping out all these levels here, which essentially look like trendline liquidity. The price drops, purges the sell-side liquidity below this low, and now creates another HRLR for us. From there, it starts moving up and builds new liquidity. Remember, when dealing with an HRLR, what are we supposed to wait for? We wait for the internal liquidity to be swept. Look at this example. We had an HRLR here, and the price formed a buy-side liquidity pool. We expect the price to come down and sweep its internal liquidity, what some people refer to as an inducement. Important note on inducement: an inducement only holds real value when it forms below an HRLR, or like in this case, above an LRLR. If you had a failure swing here, or if it was an LRLR itself, that inducement would just get wiped out along with that low resistance level. But because this is an HRLR, the price pulls back, builds sell-side liquidity, pushes back up to create a double top, and finally sweeps that internal liquidity before ripping upward. And where is it heading? Toward the low resistance liquidity. Originally, this was an HRLR, but look at how this high and the next high formed a failure swing.